Very good morning, friends. I hope you're all safe and healthy. Well, I was continuing with the series on Did You Know? But in between, I got a couple of requests where people said there is a little technical topic, which needs a little attention, and that is hedge accounting. Recently, in the revisionary test papers for May 21, the issued has put a question on cash flow hedge, a practical question on a cash flow hedge for the first time. And I thought it's a good idea, to give you a little good exposure on the concept of hedge accounting. But I'm not going to take up this hedge accounting in one single go. What I'm going to do, I have divided this into a 5-step model. And I'm going to make different videos on each and every steps for you to get a complete clarity in terms of what is hedge accounting. Well, January 21 अटेम्प्ट का जो पेपर फाइनेंशियल रिपोर्टिंग का हुआ बड़ा ही इंटरेस्टिंग पेपर था और उसकी पूरी एक डिटेल डिस्कशन के लिए मैं आपके साथ जुड़ूंगा 13th, 14th और 17th स्पेशल क्लासेस के अंदर, जिसका लिंक आपको डिस्क्रिप्शन बॉक्स के अंदर मिलेगा। और सुबह 9 से 10 1 घंटा रोज़ 13th, 14th और 17th को आपके साथ इस पूरे पेपर की एक कंप्लीट डिस्कशन आपके साथ करेंगे। डिस्कशन क्या, पेपर सॉल्व करेंगे। सो आइए, लेट्स क्रैक इट। वेल, द फर्स्ट क्वेश्चन व्हाट कम्स टू माइंड इज व्हाट इज hedge accounting? Rather, I would say, what is hedging? Now, I would put the answer in two different manners. One is I would give a very general answer that when you say hedging, it is basically a risk management tool. Now, when you say risk management, managing a risk could be two ways. One way of managing risk is, like for example, if you make an investment in a security with a fair value of, let's say, 10,000 rupees, and you want to protect this amount of 10,000 because you fear that there might be some fair value decline in the future. Now, if there is going to be a decline in the fair value in the future, you want to basically, ensure that you don't suffer that loss. Or it could also be something like, you want to sell an inventory for that matter, and that inventory is to be sold at a profit. Now, this is something which is unrealized at the moment, but you want to lock in the amount of profit which you're going to earn. So I would say hedging involves two kind of activities. It is managing the risk in such a way that you either try to protect yourself from losses, or you try to, protect your unrealized gains. But I think in specific, if I talk in terms of hedging, I would say it is accounting for a gain or a loss arising from hedged instrument, that is called a hedge item, and a hedging instrument. Now, so this is getting technical. What do you mean by a hedging instrument as well as a hedged instrument? I think let's first take an example and give you something. Imagine, let's say on 1st April 2020, a company invested in a debt instruments for 10,000 rupees measured at a fair value through other comprehensive income. Now, we know that this OCI is supposed to be with recycling because it's a debt investments. Now, to protect this value, the company acquires a derivative contract. Now, there are two things in this particular example. One is the investments in a debt instruments. Now, the debt instruments, that is the debt investments which you have made, is supposed to be hedged item. You want to basically protect it from the risk. So it is called the hedged item. And for the purpose of protecting this debt investments, we have entered into a derivative contract. Now, this derivative contract will be used so that you protect the risk, and this is called hedging instrument. So we can say the item, the investment which you want to protect is called the hedged item. And you're going to use some kind of instrument to protect yourself, and that is called a hedging instrument. I know there are a couple of questions coming to your mind at this stage, that would a hedging instrument always be a derivative instrument? Well, I think we're going to talk of that a little later. So if I say in specific terms, I would say that hedging is accounting for the gain or loss on the hedged item as well as the hedging instrument in a specific manner, such that the recognition and the measurement inconsistencies are avoided. Now you would say, what do you mean by, in a specific manner, so that you avoid the inconsistencies? I think if you come back to the example, if you apply your concepts in terms of debt investments, you know that debt investments is going to be measured at FPT OCI. So the fair value changes of the hedged item is going to be taken in other comprehensive income. But as far as the derivative is concerned, as per Ind AS 109, it is always measured at a fair value through profit and loss account, which means the fair value of the hedged item is going to go to the OCI. And the fair value changes of the derivative instrument is going to go to the P&L. So this would mean an inconsistency. So when we apply the concept of what we call hedging, the measurement principles which generally apply to a specific financial instrument would get overruled. That means that we would have a different now set of rules in terms of accounting. So you would see later that the fair value changes of the hedged item would go to the P&L, and the fair value changes of the hedging instrument will also go to the profit and loss account. So it gives you a very, you can say, specific manner of accounting. It overrules the general principles of accounting which are laid down under Ind AS 109. So we can say that if I want to understand what is hedging, I can say that there is a specific manner of accounting which we have designed for a hedged item and a hedging instrument, so that we avoid the recognition and the measurement inconsistency. In simple words, we are trying to protect ourselves from losses and to protect the unrealized gains. Now, one thing, of course, which I like to make a mention before we go deeper into hedge accounting, that hedge accounting is not mandatory. It is a prerogative of the company that it wants to apply hedge accounting or not. Now, what I've done for simplification of hedge accounting is I've created what I call KB's 5-step model. Well, as you know that, I've been very fond of creating certain step model, and in this case of hedge accounting also, I have developed a 5-step model. And what I'm going to do, I'm going to share videos with you discussing each and every step in detail in separate videos. But I think let's have a look on, what are the 5-step model, what we're looking at. Step number 1 is identifying the hedged item. Like for example, in the example which I gave you, it is a debt investments. Second is getting the hedging instrument. The derivative contract which we entered into is the hedging instrument. So we call them technically eligible hedged items. Step number 2, eligible hedging instruments. Then the step number 3 is, for application of the hedge accounting, there has to be a qualifying criteria which needs to be met. And then step number 4 is the types of qualifying hedge relationship. And we have got basically 3 kinds of, you can say, hedge relationship. One is called a fair value, one is called a cash flow, and one is called a NIFO. Now you would say this is a duplication in terms of step number 5. Well, step number 5 would be identifying what kind of hedge accounting is to be applied. And the step number 5 would be doing the accounting for the type of hedge. How would the accounting for a fair value hedge, how would the accounting for a cash flow hedge or net investment in a foreign operations would apply? So it's a simple 5-step procedure. Get the eligible qualifying hedged item, get the qualifying hedging instrument, ensure that there is a qualifying criteria for the hedge accounting, and then the types of qualifying hedge relationship, and finally doing the accounting in terms of different kinds of hedge. Isn't that interesting?